Welcome back to the channel. Today we're diving into the top 5 ETFs for high growth in 2024. These are the ones you can set and forget and watch your investments grow. Whether you're a seasoned investor or just getting started, these ETFs offer a unique opportunity to diversify your portfolio and tap into high-growth sectors. From tech-heavy portfolios to innovative disruptors, these ETFs cover a range of industries and strategies that can help you achieve your financial goals. So, grab a cup of coffee, sit back, and let's get into the top 5 ETFs for high growth in 2024. First up, we have the Vanguard Growth ETF, ticker symbol VOO. Vanguard is a name that needs no introduction in the investment world. Known for its low-cost, high-performance funds, VOO is no exception. This ETF tracks the performance of the CRSP US Large Cap Growth Index, which includes some of the biggest names in the market. Historically, VOO has delivered impressive returns, outpacing many other ETFs in the same category. Over the past decade, it has consistently shown annual returns in the double digits, making it a solid choice for growth-oriented investors. What makes VOO particularly appealing is its low expense ratio, which stands at just 0.03%. This means more of your money stays invested, compounding over time. VOO's top holdings include tech giants like Apple, Microsoft, and Amazon, which have been key drivers of its robust performance. These companies are not only leaders in their respective industries, but also have a proven track record of innovation and growth. Investing in VOO gives you exposure to these market leaders, providing a balanced mix of stability and growth potential. Another factor to consider is the fund's diversification. VOO comprises over 300 stocks, spreading risk across various sectors, including technology, healthcare, and consumer discretionary. This diversification helps cushion against market volatility, making it a safer bet for long-term growth. In terms of risk, VOO is considered moderately aggressive. While it aims for high growth, its diversified portfolio helps mitigate some of the risks associated with investing in high-growth stocks. So, if you're looking for a well-rounded ETF with a strong track record, competitive expense ratio, and broad diversification, Vanguard Growth ETF should be on your radar for 2024. Next on our list is the iShares Russell 1000 Growth ETF, ticker symbol IWF. Managed by BlackRock, this ETF focuses on large and mid-cap U.S. stocks that exhibit growth characteristics. Its benchmark, the Russell 1000 Growth Index, is composed of companies with higher price-to-book ratios and forecasted growth rates. IWF boasts a diversified portfolio with over 500 holdings, ensuring broad exposure across various sectors. Its top holdings include tech behemoths like Apple, Microsoft, and Alphabet. These companies have consistently delivered strong earnings, contributing to the ETF's stellar performance. One of the key advantages of IWF is its impressive historical returns. Over the past 5 years, it has outperformed many of its peers, delivering an average annual return of around 20%. The ETF's expense ratio is 0.19%, which is slightly higher than some competitors, but still relatively low. By investing in IWF, you're gaining access to a basket of high-growth stocks without the need to pick individual winners. IWF also offers strong liquidity, with an average daily trading volume of over 2 million shares. In terms of sector allocation, IWF is heavily weighted towards technology, healthcare, and consumer discretionary sectors. So, if you're looking for an ETF with a strong track record, diversified holdings, and a focus on quality growth, the iShares Russell 1000 Growth ETF is a compelling choice. Moving on, we have the ARK Innovation ETF, ticker symbol ARKK. This ETF is managed by ARK Invest, led by the renowned fund manager Cathie Wood. ARKK is unique in that it focuses on disruptive innovation, investing in companies that are poised to revolutionize their respective industries. This approach sets it apart from more traditional growth ETFs. RKK's portfolio consists of companies involved in cutting-edge sectors such as genomics, artificial intelligence, robotics, and fintech. Its top holdings include names like Tesla, Roku, and Square, which are at the forefront of technological advancements and market disruption. These companies have the potential to deliver exponential growth, making RKK an exciting option for growth-oriented investors. One of the standout features of ARKK is its active management style. Unlike passive ETFs that track an index, RK's portfolio is actively managed, allowing the fund to capitalize on emerging trends and opportunities. This dynamic approach has contributed to RK's impressive historical performance, with annual returns often exceeding 30%. However, it's important to note that RKK's focus on disruptive innovation comes with higher volatility. The ETF's performance can be more erratic compared to traditional growth ETFs, making it suitable for investors with a higher risk tolerance. If you're comfortable with short-term fluctuations in exchange for long-term growth potential, RKK could be a great addition to your portfolio. The expense ratio for RKK is 0.75%, which is higher than the other ETFs we've discussed. This cost reflects the active management and research required to identify and invest in disruptive companies. While the higher expense ratio may be a concern for some investors, the potential for outsized returns can justify the cost for those seeking high growth. So if you're looking for an ETF that focuses on the future and has the potential to deliver outsized returns, the ARK Innovation ETF is worth considering for 2024. Next, we have the Invesco QQQ Trust, ticker symbol QQQ. This ETF is one of the most popular and widely traded, known for its focus on technology and innovation. QQQ tracks the NASDAQ 100 index, including the largest non-financial companies on the NASDAQ. Its portfolio includes tech giants like Apple, Microsoft, Amazon, and Alphabet. These companies drive the ETF's impressive performance. Investing in QQQ gives you exposure to influential and innovative companies. Historically, QQQ has delivered strong returns, often outperforming the broader market. The expense ratio is 0.2%, low for its high growth potential. With over 50 million shares traded daily, it is highly liquid. For a strong track record, focus on technology, and excellent liquidity, consider the Invesco QQQ Trust. Finally, we have the SPDR S&P 500 Growth ETF, ticker symbol SPYG. This ETF focuses on the growth segment of the S&P 500 index, providing exposure to large-cap U.S. companies with strong growth characteristics. Managed by State Street Global Advisors, SPYG is designed to capture the upside of companies that are expected to grow faster than the broader market. SPYG's portfolio includes over 200 holdings, with a significant portion invested in technology, healthcare, and consumer discretionary sectors. Its top holdings feature well-known names like Apple, Microsoft, Amazon, and Facebook, which are leaders in their respective industries and have a proven track record of growth. One of the key advantages of SPYG is its low expense ratio, which stands at just 0.04%. This makes it one of the most cost-effective growth ETFs available, ensuring that more of your money stays invested and compounds over time. The low cost is particularly appealing for long-term investors who are looking to maximize their returns. Historically, SPYG has delivered strong performance, often outperforming the broader S&P 500 index. Over the past 5 years, it has provided annual returns in the range of 15 to 20%, making it a solid choice for growth-oriented investors. Its focus on high-growth sectors and quality companies has been a significant contributor to its success. Another notable aspect of SPYG is its diversification. With over 200 holdings, the ETF spreads risk across various sectors and industries, providing a balanced approach to growth investing. This diversification helps cushion against market volatility and reduces the impact of any single stock's performance on the overall portfolio. In terms of liquidity, SPYG is highly liquid, with an average daily trading volume of over 2 million shares. This ensures that you can easily buy and sell positions without significantly impacting the market price, making it an attractive option for both long-term investors and active traders. So, if you're looking for a cost-effective, diversified ETF with a strong track record and a focus on quality growth, the SPDR S&P 500 Growth ETF is a compelling choice for 2024. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more investment tips. Let me know in the comments which ETF you're most excited about for 2024. From Vanguard's solid growth to ARK's disruptive innovation, each of these ETFs offers unique opportunities for high growth. Remember, investing in ETFs is a great way to diversify your portfolio and tap into various sectors without the need to pick individual stocks. Until next time, happy investing and see you in the next video.